Hi, I'm Joe Guinan, and I'm here today with Blu Putnam, Chief Economist for CME Group. Blu, thanks for joining us today.
Oh, thank you, Joe.
Thanks for joining us, Blu. Today, the big question in everybody's mind, when can we expect the first rate hike? 13 out of 17 Fed governors expect liftoff this year, and yet CME futures price the odds of a rate hike at 40%. How do we reconcile that?
Well, you know, the decision not to raise rates in September really was a setback for those people who thought it was going to happen this year, because the Feds told us they're looking at China, they're really worried about the very low inflation rate, and now they've got to worry a little more about a government shutdown. So I'm afraid the Fed funds futures may have the edge here.
The Fed says that they are data dependent, and yet maybe the Fed is actually market dependent?
Well, market's a piece of data, you know. Data dependence is an addiction, and it means that you're always going to be late because you're always looking backwards, waiting on the data. So, but it also represents that if things change, they're going to change their minds.
Right. So when they do come, can we expect a 25 basis point hike, or do you think we get a baby step?
I actually think we might get a baby step followed by a sequence of 25 basis points. And the reason we might get a baby step is just that this whole idea of having ranges from 0 to 25, they invented that back in the December of 2008 in the middle of the financial panic because they didn't want to say the word zero. And I don't think ranges really serve the Fed very well. So they might get rid of those, go to 25 as the actual Fed funds rate, and then after that, 25 basis point steps.
Yes. So you think the first move might be to 25 basis points?
Right. And
would that be December?
You know, I was thinking it would be December when I listened to Janet Yellen kind of confirm. And then, but I've been watching what's going on in Congress, and the Federal Reserve has to think about the potential for a government shutdown. They have to consider that. And with the House speakership totally up for grabs, the debt ceiling coming up, I'm afraid they're going to find another excuse to move into the first quarter.
When we look at the dots, the Fed expectations of where rates will be at the end of 2016, the Fed dots are expecting that by the end of next year, Fed funds will be at 1.375, 1 3/8. But the CME futures prices tell a different story. So once again, we have a difference between the marketplace and the Fed dots. How do we reconcile that? Why is there the disparity?
Well, the dots are about these endpoint forecasts for 2016. And it really depends on when they start, because they've made a big deal of telling us that the first rate increase, then they'll skip a meeting, maybe do another. So there are 8 Fed meetings a year. So when they start, you might get 4 rate rises in the year. So if they start in December, the best they're going to get to is 1.5 now. If they start in January or February, they're not going to get to 1.5. So the futures market is being a little conservative on when they start.
Okay. So, and even if they start with a baby move of only 10 basis points or 12 basis points, even more makes the point.
Yeah, so they would, you know, if they did the baby move in December, then they would be March before they were at 50. It'd be June at 75, it'd be September at 1. They don't get to the target that these dots that they put down set. But you know, these people write the dots down before they go to the meeting. And then they publish the dots after the meeting. So it's a little strange.
Now, do you think that their rate hikes will be that predictable, 25 basis points every 2 meetings? Or do you think that they might raise 12 or raise 25 basis points and then maybe wait 6 months before they come in again?
I think this Fed is committed to being data dependent, and what that means is we will not have the lockstep approach. You know, when Greenspan did it back in 2004, 2005, every meeting 25 basis points 17 times in a row. Janet Yellen has made it clear that's not going to happen. They're going to watch the data, and they may skip 2 meetings sometimes. So they're going to keep us guessing, and they're going to keep some volatility in the Eurodollar curve.
We could even have perhaps 1 rate hike and then maybe a year with no rate hike, possibly.
If the data weakens, that would be what they would do. Now, they don't do 1 rate hike if they think that's all they're going to do, because why bother? I mean, you know, so when they do that first rate hike, they're planning on doing 5 or 6 of these things. But, you know, plans change.
Well, couldn't they do 1 rate hike just to show that they, the Fed, are in control of rates? Because I think some people wonder, isn't it possible that the Fed goes to raise rates by, let's say, 12 or 25 basis points and the market doesn't help them out and Fed funds continue to trade where they did the day before? So I think one of the arguments I've heard in terms of them acting is just to show that they in fact can control the process.
There's certainly a discussion about that, but the Fed really hates to do something, start a pattern, and then reverse itself. So I think that's the real reason they're delaying, is that when they start, they want to be able to do these 4 or 5 moves at least. And I think they can control it. They'll raise the interest they pay on what's called excess reserves, and that'll lift the Fed funds rate to their target.
Now, in September, the Fed also released their long-term view of the growth target, and they reduced the long-term growth target by a couple percentage points. So now it's straddling 2%. How material is that, and how meaningful is it that we're now expecting that the long-term growth target is slower than they used to think the long-term growth rate was?
Yeah, a slower long-term growth target is very material, very important. It's not important to when they start raising rates. It's important to determine where they stop. Because if we're only a 2% economy, and then inflation's not going to go up nearly as fast as they might have thought a couple of years ago, and so the terminal rate, might be more like 1.5 or 2% for Fed funds instead of higher. So that's where the importance of that comes in.
Now, tied to that, how much of this is due to the U.S. having an aging population? Is that part of what's in play with the lower growth target?
Absolutely. Right now, we still have very much of a consumer society, but as the percentage of the population over 65 rises above 20%, which will happen in the next decade, the over 65 crowd does not consume at the same rate per person as the 25 to 55 working person. So it does mean slower growth. The other thing is our labor force is not growing, which is part of that. And if you don't have labor force growth, the only way you grow is labor productivity, and that's not going to get you 3% growth. So you cut it back to 2.
Well, even on that note, what's going on with productivity? We had the big increases in productivity in the 80s and 90s and the computer revolution and so on, and productivity has slowed dramatically. Is that likely to continue? Do you think productivity could have another breakthrough in a positive direction, or is lower productivity part of the new normal?
I don't think lower productivity is part of the new normal. There are people that argue that, but I don't think so. I'm more optimistic than that. The biggest problem with productivity is we really don't measure it very well. So it bounces all over the place, and it shows up later and then earlier. But I think the energy of this economy, the technology that's coming down the road, productivity is going to go up. So I'm not worried about that part.
Yeah, but productivity is actually a byproduct of the other numbers rather than actually being calculated itself, I think, right?
Productivity is the residual of several large numbers, and therefore it just compounds the errors. It's not measured very well.
On the productivity note, how much of the decline in productivity do you think might be due to overregulation?
Any kind of additional regulation tends to add a certain amount of friction to the economy. Frictions to the economy slows things down. Slow things down, the productivity numbers aren't going to look quite as good. And we certainly have had a lot of new regulation, not just in the U.S., but around the world. And so that's probably a component of lower productivity.
Another question tied to productivity. With the expected target growth rates now slower or lower, does that mean that recessions are potentially more likely? If we were going to grow at 4 or 5%, to go into a recession, you have a lot to fall. If you're only going to grow at 2%, you have very little room holding you above the recession level. If 2% is now our new target growth rate, will we be expecting more recessions going forward, or what do you think?
I won't. I think the real key is for the government to have realistic expectations about what the growth rate can be, so that they have policies that support that growth rate rather than something that's not attainable. And most of the recessions we've had are really because we overstimulate the economy and then we cut it back and we hit the brakes too hard, and, or I don't think we get more recessions, but we do need realistic expectations from the government so that policies are realistic.
And this Fed is certainly not going to be accused of hitting the brakes too hard.
This Fed doesn't even know there's a brake pedal.
Now, when they do raise rates, they begin and they raise rates and they raise rates slowly, but that's only part of the monetary stimulus. You still have the $4.6 trillion balance sheet. At what part of the rate raising cycle do you think they start to let some of their investments roll off to start to decrease that aspect of the monetary stimulus?
I actually think they'll make that decision simultaneously with the rate rise decision, because once the Fed starts to raise rates, that's actually a cost to them because they're going to pay interest on excess reserves at that new higher rate. And so they're going to want to reduce their assets. But they'll just do it by letting the maturities run off. They're not going to actually sell things. But I think that decision's coming fairly soon with the rate rise.
So we could expect next year not only an increase in the Fed funds rate, but we could also expect there's probably $200 billion or more of Fed holdings maturing next year.
Yes.
So would you expect that we would have a $200 billion decrease in Fed holdings by the end of next year?
I think that's very likely. And I don't think the markets will notice. Most of the accumulation of the assets didn't cause too much of a decline in rates, except during that part around 2012 when they were doing the maturity extension program, when they were buying a lot more of 10 years or longer.
Operation Twist.
And that did, lower long-term bond yields for a little bit. But I think a lot of this $200 billion is very short-term things that roll off, and so it's not going to impact the market much.
So if they did allow $200 billion of their holdings to mature and not roll over next year, would you think that would be the new pattern, a couple $100 billion a year?
I think that's what their plan is, that it's going to take 20 years to shrink this balance sheet back to where it was, because they're just going to let it roll off.
Do you think they'll ever get back to a balance sheet under $1 trillion?
No.
Yeah. In late August, we began the market volatility sparked initially by China and the perceived slowdown in China's growth and the sell-off in the Chinese stock market. How important is China, the level of their stock market, the rate of growth in their economy, how important is that to the U.S. and even more to the global economy nowadays?
Well, the rate of growth of the Chinese economy is hugely important for the global economy. The Chinese stock market is pretty irrelevant except as it influences policy. Like the Fed clearly looked at it and delayed a decision based on the Chinese stock market. By the way, the Chinese stock market is still up 30% year on year, and the U.S. stock market is flat. So I don't know what the problem is. But yes, but the growth rate is huge. If China continues to decelerate, and that's pretty likely, it means you just don't get the same extra demand for commodities and things like that around the world. So the Brazils and the Chiles and the commodity-producing countries, Canada, Australia, don't grow as fast.
And I agree with you. You said the Chinese economy is still, Chinese stock market is still up substantially. What's the big deal? But it clearly was a big deal to the Chinese policymakers who came in with all sorts of tools to prevent the stock market from declining. How frightening is that to a global investor? Say that you want to invest in various China funds with your stock money. Should you be concerned that now you might be able to get in but you can't get out? And how concerning is that to, let's say, Western-style investors, that the fact that the Chinese government showed that they want to intervene to prop up their stock market? They had no problem with it going up 60% in a year, but they don't want it to go down the whole 60%.
Well, it's certainly a little worrying, but remember, after the 1987 stock market crash in the U.S. and then the S&L crisis, we did some pretty interesting things. Attorney generals went after various politicians, the Keating Five. Those charges never happened, Those people have had successful careers. But the Chinese response is not actually all that unusual. We've done most of those things in the U.S. before. It just caught markets by surprise. And they were already worried about China slowing down. And so I think it had an outsized impact. And it did scare investors away. There's no doubt about that.
Right. In terms of actually affecting us directly, clearly they're a big part of global growth, but in terms of affecting us directly, we export a de minimis amount to China, so the direct effect on us is not real material. But you see the counterparties who do trade a lot with China, such as Australia. You see the 30% decline in the Australian dollar. You see the effect on their direct trading partners has been fairly pronounced. Do we expect that to continue? If you were going to prognosticate, is the 70-cent range in the Australian dollar likely to be a bottom, or is Australian dollar likely to take another whack on the chin?
I actually think that the slowdown in the Chinese economy is about 150% discounted by the markets, and that everybody's gotten the email and reacted, and maybe even twice. And so I think we've overdone this reaction. Now, to frame the question a little differently, did the Chinese stock market get ahead of things, or is it correcting to the actual fundamentals? And what I think happened, the Chinese lowered interest rates, they put out a lot of new loans, so it was a kind of a quantitative easing version, and instead of helping the economy, it actually pushed asset prices up. And so the asset prices never did reflect the fundamentals, that the economy was slowing, that exports were slowing. It just got ahead of itself. So if you believe that story, then the impact has already been felt on Australia and these other countries.
So I wonder if that's at all relevant to the United States. Central bank policy affecting asset prices. When we look at some of the overbuilding that we've done in the United States, for example, in the energy sector, so we did too much drilling, and that led to oil price collapse. Do you think the Fed funds rate and the Fed keeping rates as low as they have for as long as they have, did that somehow play a role in the decision to do as much drilling as we did in the United States?
It probably did, because anytime interest rates are very low, you know, Greenspan had interest rates at 1% for several years, and it certainly encouraged an outsized housing boom that cost us a huge recession. And interest rates at zero, money flows to the hot sector. Last time it was housing, this time it was energy. So we probably had a lot more lending going into the energy sector than otherwise would have happened. And so yes, it had that impact.
So yeah, I don't disagree, and yet that seems to have not gotten an enormous amount of press. We hear a lot of press about how the low Fed funds rate has propped up stock prices and how they want it to prop up housing prices, but we don't hear a lot about how the low Fed funds rate potentially helped cause the overproduction of energy.
I mean, energy is just is the hot sector. But anytime you have zero interest rates on short-term rates, you give a little markup for credit risk, that's pretty attractive to people who want to grow their businesses who are in a hot industry, so you can certainly get the extra lending. By the way, that's going to mean that, interestingly enough, that we see higher oil prices rather than lower oil prices, because when oil prices fell, the first thing that happened is these producers had a lot of debt, so they had to keep the oil flowing to pay the cash down. I mean, you know, to have the cash flow. But now we're a year later, and they haven't made any new investments for a year. I mean, once the oil price fell, so a year after no new investments, we're going to start seeing production declines for the first time. And so we may see a move toward kind of the upper range in oil prices over the next 3 or 4 months.
Well, that'll be interesting. That'll also affect the inflation numbers on a year-over-year basis.
Well, you know, one of the things economists are very good at is forecasting the past. And what we do is we know that energy prices fell dramatically in the first quarter of this year. And so on year-over-year percent comparisons, that will drop out in the first quarter of next year. So it's almost a no-brainer that the general inflation rate that was pushed down by energy prices will go back up to about 1.5% to 1.7% by March.
So you're expecting energy prices to start to gravitate a bit higher?
But what I just said, energy prices don't have to move at all to get the general year-over-year inflation rate back to 1.5%, because you're comparing to a year ago.
Right.
But yes, I am expecting a slight increase in energy prices upward rather than this extrapolation downward.
And it might be held off if we get this strong El Nino pattern this winter. It might not be this winter, but perhaps next spring, as more and more Permian Basin rigs shut down and so on. with
Yes.
less rigs drilling, less supply of oil, and so in the next year we should start to see oil ticking up in price.
Yes, what you just, on the El Nino, that's going to particularly hit natural gas. If we have a warmer than a normal winter, which we did the last time we had our super strong El Nino, so it's like 1998. And so if we have that pattern repeated, natural gas prices will stay low, and so will heating oil prices. But then we'll see, we could then after that see some upward creep in both oil and natural gas prices.
So you are mildly bullish on energy prices. You are mildly bullish on, let's say, the Australian dollar currency. Would you say mildly bullish on commodities in general? Is the commodity glut and the downward price in commodities nearing its end as well, do you think?
You know, when things are absolutely terrible and then they go to just like pretty bad, that's when the most money is made. And I really think the market has discounted the absolute terrible scenario for most commodities. And so I believe what news we're going to get over the next 6 months may not be very good news, but it's going to be better than was expected. And so we're going to bounce off the bottoms on a lot of, we potentially can bounce off the bottoms. That's just a base case, of course. If China really does implode, then we're going lower on commodity prices. Right. But I don't think that's going to happen.
Well, I agree with you. And a lot of these commodities and currencies seem to be bouncing along their lows, which I also think tends to show that they're getting a base of support.
Yeah, the emerging market currencies largely have, some of them have pretty high interest rates. I mean, Brazil, 13–14% interest rates. If you decide that that currency has hit its bottom, you get paid to buy that thing quite substantially. And of course, people have been afraid to buy it because of political risk. But again, the worst is really in the price. So you don't even need good news. You just need not so bad news to change the market dynamics next year.
Well, great. Hey, Blu, thank you very much. Thanks for joining me today, and we very much appreciate all your sage comments. Thank you.